The Money Show.
Personal Finance with Warren Ingram.
Well, of course, time on a Tuesday evening to speak to Warren Ingram about personal finance, and good to hear from you. Your questions for him on 011 8830702 and 021 Your voice note questions as well, if you prefer that, on 072 702 1702. And one of the big issues when you retire is what you do and how you are paid the money from your investments. So if you are living on the funds that you have accumulated, if you're living on the funds you've saved and invested for your retirement, how do you actually get paid out? Warren Ingram, good evening. There are kind of two big categories of this, right? Two sort of big ways, generally speaking, that you can get paid out from these investments.
You're right, Stephen, and it breaks up really around our retirement fund. So when you reach retirement age, in this country, retirement age is 55, but most of us are probably going to keep going flat out until we're 65. And when you get to that age and you officially retire from your RA or your pension fund or your provident fund, you're faced with the choice at that time to either take the money as a monthly pension, and that's kind of something that a lot of our parents or maybe our grandparents would have known about. When you get a guaranteed income and you know exactly what the amount is, and you know you hope it goes up with inflation every year. The alternative is something called a living annuity, and that's, I mean, it's now quite old. It's you know easily 20 years old, but that's not so certain. The outcome that you have there is quite variable. So we're faced with that choice as we hit retirement, and for a lot of people, Stephen, it's probably the biggest decision they make after or financial decision, let's be clear, after they buy a house. So it is a big one, and it's something we need to pay attention to.
Is it something that people are properly prepared for? I mean, yes, we all talk about, you know, how to invest the best way, but it's a big decision to make, and often you'll be making it with someone else. So you really need to think about it very carefully.
You do, and I find that the answer to the question is no. I think a lot of us are not prepared for it. Number one, there's a financial education, financial literacy element to this, because when you work for a salary for your whole life, or you run your own business and you kind of go month to month, you don't really pay attention to investments in the way that you will when you're retired, because that's probably the first time in life you become a professional investor. You actually live off the money that's invested on your behalf. And so these decisions are often, I mean, it sounds funny to say, but they're often quite traumatic. People find, huge amounts of stress, and it's an area they don't understand well at all. And then, I guess the downside is that you become prey sometimes to dodgy selling tactics, and other times just the emotion overrides logic and reason. And so, you might be getting great advice, but the emotions, prevent you from hearing what you need to hear, and you make the decision based on emotion. And unfortunately, emotions are very bad ways for us to make sound, sensible decisions around money.
Okay, so let's just sort of start with these two things then. How do you get a guaranteed income from your retirement investments? How do you make that work?
So these are the industry jargon for these. They're typically called life annuities or guaranteed annuity, and they will be the guaranteed pension. So what happens is you retire, and then you essentially take your retirement capital and you do a transaction with an insurance company. And the reason why you're doing an insurance company is because they're contracting with you. They're taking your retirement capital, and in exchange for that capital, they're guaranteeing you an income for the rest of your life. And the way that they'll do that is they'll say, please explain your age, your medical circumstances, and your state of health as you are now. And then how would you like your income to grow? So would you like it to grow by inflation, or would you like it to grow at a fixed percentage? For example, it's quite common where they'll say, you start this year at 50,000 Rand a month, and then next year we'll increase it by 5% as an example. And then the other thing that they'll add to that is if you are married, then your spouse might be entitled to a portion of that. It's usually about 75% of that pension amount if you die. So on the surface, it's quite a nice product, because if you don't understand investments, you don't really want to pay attention to markets and politicians and the like, you might go for this. And a lot of people would be tempted. The thing to understand here is you've paid all that capital to the life assurance company, and on the death of you and your spouse, that's it. There is no money. There is no inheritance for your children. So it's the one very big consideration when you make the call to choose this guaranteed or life annuity.
Okay, so on one extreme, you could live for, I don't know, 30 or 40 years and still get paid out at the end of it. On the other extreme, you could both pass away tomorrow in a car accident, and basically, I hate to put it like this, the company that you bought it from wins the bet.
Yeah, I mean, often they're a little bit kinder to us, Stephen. They might give you kind of a guaranteed time. For example, they might say, well, if you do die in the first 5 years, we'll pay out a portion of the capital to your beneficiaries. But let's say you die in year 6 or year 7, then all of that money goes to the insurance company. And I mean, I think the important thing to note here is, if you're making this decision, it's you on your own. On the other side of the equation is a very large company that employs lots of, medical specialists, actuaries, and the like. And so when they give you an indication of how much income they're happy to pay out, they're doing a calculation to say, let's say we expect you to live until age 84. If you die at age 80, then as the insurance company, they win. And if you die at the age of 99, then you win. And well, you don't win because you're dead, but financially you're better off than if you had died on the day that they expected at age 84.
I presume it also means that if something happens and you need a little bit more money now, there's no way that you can get it. If you have a medical emergency or something, you have to make other provision for it because you won't be able to get it.
Exactly right. So your capital is gone. That money is paid. It's basically almost just one very big insurance premium. There is a contract, and what you get paid on a monthly basis is it. There is no negotiation. There's no going back or undoing it or the like. You've done this. Once you start that process, it runs for the rest of your life in the most literal sense.
Okay, and then we don't know what's going to happen, but what happens if inflation suddenly goes to 20%? I mean, you would have to make sure that's priced in quite carefully.
You're hitting the other very sore point on something like this, because there was a time in South Africa where inflation would go right up to sort of 15%. And if you were, if you'd selected an option where you said, I'm happy to start with a little bit of a higher monthly guaranteed pension and very happy just to take 5% escalation, you would be in real trouble that if inflation runs at a level of 10 or 11 or 15% a year for a period of time, because it's going to erode the buying power of your pension very, very quickly. And again, that's a contract now. There's no redoing it. So I think that you're hitting the one thing that I would say to people always is, if you're going to choose something like this, and it's not bad all the time. There are circumstances where these are very good for people, but you cannot choose one that just gives you a fixed percentage growth on your income every year. You can't just say, give me 5%. You have to take the one that says, I want that my income linked to inflation. And the reason why you might be tempted to take the fixed escalation at, let's say, 5% a year is that they might say your starting pension, if you want to take an inflation increase, is going to be 50,000 Rand a month. But if you want the fixed escalation of 5% a year, we'll start you out at 55,000 Rand a month. So it's a little bit tempting to take the higher income on day one, because we don't understand buying power and we don't understand the impact of cost of living on our money over a decade or two.
Okay, let's talk now about the other sort of main product, which is a variable income. How does that work?
So these are called living annuities, and they generally came into existence round about the time that just after unit trusts were developed. And the idea here is that you have your capital, you invest that in a product that will give you an income on a monthly basis, but there is no guarantee here. So you take your money, you invest it in a living annuity. And if you start that, let's say on the 1st of September every year, what will happen is, if you do it in 2025 on the 1st of September, you're going to have the option to elect an income, and it will be at the lowest end. You can say, pay me out 2.5% of the value of my investment on a monthly basis. So you're going to have 2.5% over the whole year, but they divide that by 12 and they give you a monthly income. You can go right up to a level of 17.5% of the value of your investment. And again, that will be divided by 12 and paid to you on a monthly basis. The trick here is you can't change that income percentage from month to month. So if you started on the 1st of September, the next time you can change your income will be on the 1st of September in the following year. I think it's obvious, but I just want to make the point. You can't expect that if you start with, let's say, R1 million in your retirement fund, and you're drawing 17.5%, you must know that that's not going to last very long. I think it probably lasts you 5 or 6 years, and you will have eroded all the capital that you've got in that investment. So that's the real trick with something like this, is people are tempted to start very young. Let's say they retire at 55 and they start with a very high level of income, not really thinking through that, they're actually doing themselves a huge disservice later in life.
What happens then if you die and you've still got money left over?
If you've managed your living annuity well, and you have children or other financial beneficiaries, you can nominate them as beneficiaries on this investment, and it's treated as a life assurance product. So from that perspective, you can nominate beneficiaries who immediately will become entitled to the balance of your living annuity. So if you've done well and you get to age 99 and you die at that age, and there's you don't have a spouse and your children are still alive, they become beneficiaries of that money. And why that's attractive is in South Africa, you don't pay estate duty or executors fees on the benefits of a retirement fund when it goes from the owner to the next generation. So it's a very efficient estate planning and kind of tax planning tool if you can manage your expenses well over your lifetime.
We're talking to Warren Ingram, the co-founder of Galileo Capital. Your questions for him as well. He's a certified financial planner about personal finance. In a moment, we'll hear how you choose between these two major products. And also, there's in fact a question from Peter this evening, asking what happens to our investments when the Springboks are winning? Can we make money by buying shares when they win? Obviously looking at the second test rather than the first. We'll have an answer for you, Peter, in just a moment.
The Money Show. Personal Finance with Warren Ingram.
Well, Warren Ingram, of course, is a certified financial planner and co-founder of Galileo Capital. Warren, a question from Peter. What happens to our investments when the Springboks are winning? Can we make money by buying shares when they win? I thought that was an interesting question.
I love the question. I actually had to go and do some research to find out if there is a link between winning teams and winning shares. And unfortunately, the answer to Peter is no. What happens is there is a benefit. So in the stock markets, they always talk about sentiment, the way we feel about things. And on a Monday morning after the Springboks have won, the whole country feels a little bit better. And that is it is an impact. But I think it has a slight economic impact. And if the Springboks keep winning for a period of time, that does lift our mood as a country, and that positive sentiment can have a very small economic impact. But unfortunately, it doesn't drive markets. Stock markets are driven by cold, hard machines and sort of fairly ruthless hyper rational people. Apparently, that's how they like to tell us they are, and so they don't get emotional about shares when they get into the office on a Monday morning. So unfortunately, no, Peter, that's not a good link at all. And I looked all around the world, whether it's in America or anywhere where the big sports teams win, it just has a slight sentiment bump, but unfortunately not a money maker.
I'm kind of strangely not surprised, I suppose. Okay, so we've been discussing the two big sort of ways to get paid out. One is the sort of guaranteed fixed income for the rest of your life. The other is a variable income. How do you choose between the two? Part of it might well be if you have children you want to leave something for.
Yeah, I think you're touching on, for me, probably maybe the biggest distinguishing point is if you've worked hard your whole life and you want to leave something behind to your kids. A living annuity is a heck of an inheritance to pass along because it saves you so much in tax. We pay away anywhere kind of between 18 to 25% of our capital in taxes when we die, and sometimes double that if there are capital gains and estate duty. So I don't I think I always want people to try and get the most tax efficient options on their investments, and for me it's one that we should think very carefully about. So I think that if you've got kids, this is something to consider very seriously. The other side of this is if you're reaching retirement and you're horribly underfunded. In other words, you have no way of having enough money when you are going to retire. You might want to look at a guaranteed income. And the reason for that is it is likely that they'll pay you a bit more at the start of your retirement than you would draw from your living annuity. I mentioned that you shouldn't start at 17.5%. And in reality, if you retire at age 55, you probably should only draw 2.5% from your living annuity if you retire, and so if 2.5% is not going to pay the bills over a year, then unfortunately you might need to look at a life annuity. So I think your relative level of wealth is important. If you are fairly comfortable and you can afford to live on let's say 2.5% to 5% of the value of your living annuity when you retire, especially at the early part of your retirement, then I think a living annuity might work for you. Also important here is the control over your money, because once you've done a contract with an insurance company and you've got a guaranteed pension, that's it. There's nothing more to discuss. That's what you're going to get for the rest of your life. But some people want to know that they've got exposure to overseas markets and they have more allocation, or let's say a greater allocation to cash or a greater allocation to shares. Those kinds of decisions you can make in a living annuity, but you simply can't with a guaranteed or life annuity. And then maybe just, it's quite a tough one, but one to consider is if you're in bad health at retirement and you think you're fairly certain that you're going to die quite some time before the actuaries say you're going to die, then a living annuity might be better because you can draw a higher percentage at the start of your retirement, with a fairly high conviction that you can live well for a short period of time on the income, even if you're not in good health. But if you're on the other side of that equation and you've got longevity in your family and you've done all the right things that your doctors have told you to do about eating well and exercising and all of those things, and you think there's a good chance that you live past age 85 and maybe closer to 95, then consider a life annuity, because then you're going to get one over on the actuaries and make their calculations look bad.
I never want to shy away from getting one over the actuaries. Warren Ingram, thanks very much indeed, the co-founder of Galileo Capital and, of course, our expert on personal finance. It's such an interesting question about how you actually how you actually spend the money or how you actually receive the money that we've been talking about investments for such a long time. Warren Ingram, thanks very much indeed.